Hey everyone, welcome to another episode of the FranklinDAO podcast. Today we have the winner of Pulls the Most, Otakar here to talk to us about his Aave grant. Otakar, do you want to talk a little bit about your research, introduce it a little bit?
Yeah, sure. So I focused on Aave and the ways that Aave can improve the efficiency of its protocol. And furthermore, what are the new features that Aave could introduce that would really play on its strengths within DeFi and within lending and borrowing. I've specifically focused on the isolation mode and the efficiency mode, and then have proposed that Aave makes a move into real-world asset lending, which was previously something that Aave has done in collaboration with Centrifuge. However, one of the main limitations that Centrifuge has had was attracting lenders to its platform. So my research has gone into how can Aave alleviate that by introducing a deposits module, which would be tailored toward primarily people in emerging markets, where they could deposit their money that could then be used by the Aave protocol either via Centrifuge, or Aave could also make its own lending arm to real-world businesses, and how this deposit money could be then plowed into real-world asset lending.
Okay, let's back up on a high level. What is Aave?
So Aave is a decentralized lending protocol, which currently functions through over-collateralized lending,
Right.
which means that a person has to deposit more than $1 to borrow $1
Right,
worth
and,
of
and for
tokens.
crypto assets, what that really means is that you're just speculating, right? You're just
Yeah.
leveraging up on assets. Okay, so interesting, right? Like this is really key, right? We really want DeFi to be more than just a speculation tool and kind of a gambling tool. And so this I think is really interesting kind of suggestions. I guess let's start specifically. Let's go suggestion by suggestion. Maybe that's best. Where do you want to start?
So I think we can start in the real-world assets.
Okay, so first of all, why would lending to real-world assets be beneficial for Aave? I know MakerDAO has done this, right?
Yeah.
Why is this better than lending to Maple or some other like kind of crypto adjacent protocol instead?
So the reason for that is really that the TAM, or the total addressable market of real world asset lending, is way larger, and also if Aave would move into real world assets, it would be competing against legacy institutions where it has some inherent advantages, although it also has some disadvantages, which it could leverage to unlock this new very significant revenue stream for itself.
Okay. And so how would this fit in, right? So like, how would the cash work? So I deposit ETH and take ETH back out, or USDC back out, right? And so then you're telling me that the ETH I give Aave would then be converted to cash and then lent it out to like a real world organization, right?
Well, it could either be converted into cash, but to maintain or to make operations for Aave easier, it could also send the ETH to the organization, and the organization would then convert it into cash.
Themselves. Okay. Instantly, right?
Yeah.
What is concerning is risk of a bank run, right? Things like that. Do you want to talk about risk mitigation for this specific strategy?
Yeah, so risk of a bank run is very significant. I mean, we've seen that with Silicon Valley Bank, and all the issues are exacerbated by the fact that you can withdraw on the blockchain almost instantly.
Right.
So what I've proposed is that Aave introduces also savings deposit account. So the way that would work is you lock in your money for at least several months, maybe up to a year, or have very limited withdrawal options. And the other way to mitigate this risk is to match the duration of the deposits with the duration of the loans. So that, of course, if you have an instant bank run, then you're pretty much screwed. But if you're just like battling a steady decrease in deposits, which is probably more probable than one at a time bank run, then having assets or loans, because loans are an asset for a bank, having assets that match the duration or expected duration of these deposits would alleviate that concern, because Aave would get repaid. Basically, if a person deposits with an expected duration length of 3 months and you loan out the money for a 3-month loan, then there is no duration mismatch. So once the person is expected to withdraw in those 3 months, you will get back the money that you lent out. So the way I've recommended that Aave mitigates the duration mismatch is by financing primarily working capital needs of businesses. So what you can imagine under the working capital needs is a business needs to buy inventories, a business needs to fund payroll for this month, and these are all very short-term needs. For a business, it's very very nice to have someone financing these things, because it improves your cash flow, since you're basically using other people's money or like the loan to finance your own obligations. So it has positive cash flows implications for the business, and of course Aave earns an interest on that. So that's a good way to match, I guess, the needs of those businesses with the Aave's product, while also minimizing the duration mismatch risk.
Got it. So you're suggesting, right? Like I find basically you're suggesting a vault, right? Rather than I would not actually get anything back when I lend out, or are you saying I would still get some amount back?
No, the depositors would accrue interest rates.
Right, it would be an interest.
Yeah.
So it would be, okay, so I give 1 ETH to Aave, right? And you're saying I lock it up for some duration, like a year, and in exchange for locking it up for longer, I get a higher interest rate.
Yeah.
Then Aave, this is all in code, right? So it happened and there's nothing I can do about it, and then Aave turns around, lends it to some real world asset, and then you get it, they make some cut, goes to treasury, and then whatever. Okay, yeah, that's really interesting. Right, so really the main risks are like default, right? And I guess there's the problem with all this stuff, right, is that there ends up being a centralized, committee that ends up deciding where to lend to, etc. Which happens for Maple, happens for Maker, and so far it's been okay. I think there hasn't really been any huge default. I think maybe just one on Maple. That's interesting. I'm gonna stop rambling. What's the second suggestion?
Well, if I can also mention another important thing that I sort of neglected within the risk of a bank run. So what Aave could do as well is to insure itself on insurance protocols, DeFi insurance protocols, and spread that risk amongst a lot of them. So it would not be insuring itself just on one of them, but spreading out the risk. And I think that first of all, it would decrease the probability of a bank run, because if your deposits are insured, similar to FDIC insurance, then you're not as likely to try to withdraw your money, and it would largely prevent a bank run, and would also attract the deposits, because currently the FDIC insurance or deposit guarantee only works in the
25,000.
Yeah, but the important thing is that it's a US thing, and it might not be present in the markets that I propose Aave would be targeting.
So for emerging countries, this is really just, you're saying, safer than maybe their current banking options, right?
Yeah.
Just really quickly, so you're saying that the user would get insurance, or Aave would get insurance?
The user would get insurance on its fund.
And I've never heard of DeFi insurance protocols before. Can you really quickly, 2 sentences, what is that?
Yeah, so a DeFi insurance protocols is a protocol that has a set event that it is insuring against. Usually it would be against a DPEG of a stablecoin, and through oracles, it would be able to detect when that situation has happened. For example, with USD, when it's backdropped, USD, back when Anchor.
UST.
Yeah. So you could have insured yourself against that, and once the peg went down, for example, below $0.9, then you would get the money back for paying some fixed amount. And with these deposits, you could structure it, for example, in the way that you are expecting that in a year you would get access to the money that you've put in, and if you don't get that access, the insurance protocol would pay out the money or cover the difference.
Okay, so I'm someone in an emerging country. I don't have many banking options. A lot of real crypto adoption comes from people who have really kind of volatile currencies anyways, right? So they can't turn around to the bank and just ask them to hold my ETH, right? So Aave becomes that kind of centralized player. You can hedge out your risk in a lot of different ways. I think it's really interesting. Okay, let's move on to the second suggestion then.
Yeah, so the second suggestion is to revamp the isolation mode. So the isolation mode is a new feature within Aave version 3, and it allows the user to use assets that were previously not allowed on Aave, and deposit them as collateral, and then borrow against them. Currently, there is around 50 million in dollars borrowed in the isolation mode, which is a pretty big improvement. It amounts to around 200K in annual revenues at an annualized run rate. And the main issue that I see with it is that the users are heavily disincentivized against entering that mode. And the main disincentive comes from the fact that if you go into the isolation mode, you cannot deposit other assets as collateral, and you cannot borrow other assets as collateral. So that's the main part that I have proposed revamping.
Right. Okay. So I enter isolation mode. It allows me to borrow more for however much collateral I put in.
Yeah.
But I only can borrow the same exact asset. Right.
Yeah.
ETH for ETH, etc., etc. And I think you looked at some Dune dashboards, right? And the argument was this was supposed to make Aave more capital efficient, but it wasn't really being utilized much. And as a product, it seemed to, I don't want to say fail, but really not reach its aspirations. Correct.
Yeah.
Do you want to talk really quickly about the Dune dashboards, or?
Yeah, so basically the isolation mode as well as the efficiency mode, which is not really part of our part of the investigation here, but both of them were supposed to raise the efficiency of the protocol, which I guess you can measure by the borrowings to total value locked ratio or some other ratio similar to that. And the difference between Aave v3 and Aave v2 is fairly negligible. So we're saying that despite intentions to improve the protocol, the adoption of these has not been significant enough to actually improve the capital efficiency.
Got it. And so then what is your proposed fix?
Yeah, so the proposed fix is to make the isolation mode more accessible and make it easier for a given person to enter it and interact within it. I guess not easier to enter it in some sense, like make the UI better, but just not disincentivize them so much from entering it, and also make the isolation mode, make more assets available in the isolation mode. And the parameters for an individual asset can be set up in a way that minimizes the risk to the protocol. But currently, I feel that the parameters are set up in a way that makes the assets that can be borrowed in the isolation mode way more riskier than they truly are. So like if you take the assets that are in isolation mode, it's frax or USDT, for example. And those are like very stable crypto assets.
Right.
I mean, they've existed for several years and they're stable coins. So in my opinion, it makes very little sense to force the user to only be able to deposit this as collateral and borrow some other token, like, and not be able to actually deposit this as collateral and only borrow this token and not do anything else. So what makes more sense, in my opinion, is if you deposit these assets, then sure, you can, this collateral can only be used to borrow more of the same asset, but you should also be able to deposit some other form of collateral and also borrow some other assets against that other collateral. And the reasoning behind that is a user that would have deposited some other assets as well and would borrow against them would probably be less risky than a user that deposits frax and only borrows against frax, or if there was like some other asset that would be even riskier than frax, like say Dogecoin, he only deposits Doge and only borrows Doge, then that's a riskier person for the protocol than a person that deposits Doge and ETH and then borrows Doge against that Doge and USDC against that ETH.
Well, what is the risk for Aave if it's like Doge and Doge, right? Like, because the assets are perfectly correlated, like you would never go under your loan to value, correct?
Yeah.
So why would that be risky at all?
I mean, that's like the way I may have put it not in a great way, but yeah, basically the way the isolation mode is designed, it's not risky at all. But it's just the person would potentially be risky if he was depositing Doge and only borrowing other assets.
Okay, makes sense, right? So you want to add more optionality into isolation mode to make it more useful and make the actual protocol more capital efficient, right?
Yeah.
This adds some risk, but the argument is that it would make Aave as a whole significantly more capital efficient, which makes sense to me. And you mentioned you can do this with A tokens, right, to prevent looping, which is another risk. Is that related to isolation mode?
Not really.
Okay, all right. Well, let's talk about that one then. Let's talk about the third suggestion. You have so many great ideas. Do you want to talk about it?
Yeah, sure. So the third proposal is to leverage A tokens within the broader DeFi ecosystem. That's something that Compound has done with its C tokens, and it's something that Aave has not really done. Which means that the capital efficiency of the protocol is inherently limited, because the way it works in like real finance or real world finance is that you loan out to someone, you get and you have that loan and can use it as an asset, or you can also trade deposits. Like those are assets that you have and can use them in further business interactions. But by limiting the usage of the A token, you're basically taking one part of that equation and basically setting it impossible to do anything further with it. So by allowing to use a token as collateral in borrowing, maybe not in Aave, because that's again a risk consideration that the protocol would have to make. Like, is it worth it to allow it to do it in our protocol? Because it would allow the user to loop his funds, which might be overly risky. But by entering partnerships with other protocols and allowing the other protocol's depository token to be used as collateral on Aave, and the other protocol allowing a token to be used on that protocol, it would first of all, it would improve the attractiveness of Aave for lenders and borrowers, and it would also improve the overall capital efficiency of the DeFi lending ecosystem.
Okay, can you run me through how it would work as a user? Is this something that I'm sorry, I'm a little unclear. Is a token something that currently exists? No, right?
Yeah, a token is something that currently exists.
Okay. Can you run me through how it would work as a current user then?
Yeah, so a tokens are minted when a user supplies an asset to Aave as collateral. And so once you have that token, it basically signifies that you have a claim on the, I guess not vault, but like the money within Aave or the tokens within Aave. So if you deposit an ETH into as collateral into Aave, you get a ETH, and you can burn the a ETH to get the ETH back.
Okay.
So
I put in ETH. I automatically get a ETH back.
Yeah.
If I then borrow USDC based on my collateral that is already locked in, does my a ETH get burned, or like I still keep that?
So if you borrow USDC, then you cannot burn the a ETH back.
Okay, got it.
So you take the a ETH, which is a depository, the token of deposit, and you could, for example, use it as collateral in another protocol to borrow more. And the reasoning behind why that would work is it's a real form of an asset, and it's basically a token derivative. It's a claim on the ETH token. So there is nothing inherently risky about it. The only risk that the ETH token brings is if I guess you would have a failure of the Aave protocol, you would not get access to those funds anymore. But that's a tail risk that's not very likely.
So, I mean, this is not really a suggestion for Aave, right? This is, like, nothing is preventing me, correct, from creating a dApp that takes A tokens.
I mean, that's true, but Aave could work more actively with existing protocols. And also, depending on the assessment of risk that the protocol makes, if it would be overly risky to allow A tokens to be used as collateral on the protocol. So if they say that it's not overly risky, then Aave would be able to, or users could be able to use A tokens on Aave itself, which would allow them to loop their deposits and really improve the capital efficiency of the protocol, because instead of borrowing once on a given like on one ETH, borrowing 0.8 ETH worth of USDC, you could do that multiple times.
Right. I mean, yeah. I mean, it seems inherently pretty safe, I guess. Right. Like you're I guess you're looping, right? So you deposit your ETH, you get like 1% yield. It's like really small, right? And then you get the ETH back, and then at least you can do something with it, right? Honestly, I'm really not sure why anyone is depositing into Aave if they're not borrowing back out, because like the USDC rate is 0.49% or something crazy. Maybe it's the emerging countries, as you were talking about, because T-bills are just so much better. Okay, cool. Then I guess is there any other suggestions?
No, those are the three suggestions that I've proposed.
Okay.
Using the A token, improving the isolation mode, and moving more aggressively into real world lending.
Right. I mean, I think, yeah, like a lot of people, right, really want crypto to move more into have more of a real world impact. One of my friends recently said, like, he, I guess, left the space and he's like, nobody talks about crypto, bro. Outside of your little circle, like, nobody talks about it. And so I think it's really good, right? I think it's really important for, you know, Aave and crypto in general to get more involved with, you know, things in real life. Otakar, do you want to shout yourself out? You're, you know, from the Czech Republic.
Yeah.
You're studying at Wharton, as if listeners cannot tell from this finance discussion. Anything else you want to talk about?
I mean, not really.
Okay. Shout yourself out on Twitter.
Yeah, my Twitter handle is Otakar Karnek, Otakar, and then Koranek.
Your last name has an A in it, not an I. Kora.
I is like the. I think it's I. Yeah.
Okay.
I sometimes have problem distinguishing like the spelling of I and A.
Oh, okay.
Yeah,
okay.
it's I.
Okay. Wow, I can't believe I just corrected someone on how to spell his last name.
Yeah.
Yeah, he has a little black and white profile picture. It's very serious looking. You can find more of our content at FranklinDAO _. And you can find me at Eric B. John. And thank you for listening. Thank you for coming, Otakar.
Yeah,
Thanks
thank
so
you.
much.